Fashion retailer Truworths is heavily reliant on credit sales, with more than 70% of their revenue coming from sales on account. This could call for some concern in the current economic climate where interest rates are rising and households are currently under pressure. But despite the challenges, the group recently released quite a strong trading statement forecasting its diluted headline earnings per share for the 26 weeks to 27th of December. They said they would be up by as much as 25%. Joining us to discuss the outlook for Truworths is Finweek contributor, that's Mushima Gama. Mushima, hi, and of course she joins us live from our Cape Town studio. Mushima, if you look at Truworths in relation to the other retailers, it seemed to be an underperformer, even though, as we stated, trading update looked pretty positive.
Hi, Debbie. Yeah, well, you know, their financials previously haven't been that hot. Understandably so. There's consumer spending was curbed and the bad debts. You did mention that it is a retailer, a credit sales retailer, and you also mentioned the 70% that accounted for those sales. So they have been struggling in that aspect because of economic reasons. But another reason why they've been lagging so much is they're just failing or struggling to be innovative in terms of, particularly at the time when those large fashion brands came in, the Zaras and what not came in. They just did not manage to at least address or protect their market share, whereas the peers actually did step up to that.
Mushima, you made an important point there. You're talking about other retailers that came into the South African markets, your likes of Zara. Is Truworths able to compete? They are looking at rebranding their whole look. Will this work?
Well, we need to bear in mind that they are approaching a different target market to the consumer that would buy from these international fashion houses. So you could spare them in that aspect. But if you have to compare apples with your Woolworths and your Fashinis, which are also credit sales retailers, they are seriously lagging, and the revamp is long overdue. I mean, Woolworths and Fashini have been working tirelessly to reinvent themselves and become more edgy. And although Truworths has been acquiring some other businesses, like upping the kiddie section, it's still not at par to what the other retailers are doing. So they really need to keep up with the times and try and meet what its peers are doing rather.
Mushima, just looking at the movement that we've seen in the executive or in the top tier of management there, the CEO designate stepping away just after 6 months. I mean, this was seen to be a very positive move, bringing him in. It would be a breath of fresh air. Him now leaving, does this leave investors feeling a little bit cautious about Truworths once again?
Well, to me, the majority consensus of having a fresh outlook is still there. It remains. And it seems at this point, as you had mentioned, that the financials were looking were looking up. Investors are warming up to the share, but with the CEO dynamics, I think the question at this point is, what is the problem? Is it the reluctancy to let go, or is it a power struggle, which is kind of causing the share price to move sideways at this point? So they just kind of have to address those to start seeing a rise in the share price.
Mushima, thanks so much. Lovely having you as always. That was Finweek contributor Mushima Gama. Coming up, let's take a look at this week's cover story.